You can think of raising the Fed rate as somewhat of a brake pedal in the economy. Frankly, it makes a lot of things more expensive. Certainly things that are bought with credit, but then it has downstream effects on even things that aren't bought with credit. So if the car payment or your home mortgage payment is absorbing more of your monthly budget, then you have less money to buy other things. So actually, it affects everything, even those that aren't things that aren't bought on credit. So, and my concern with the way the Federal Reserve is making decisions is that they're just operating with too much latency. Basically, the data is somewhat stale. So the Federal Reserve was slow to raise interest rates, and now I think they're going to be slow to lower them. That appears to be the case.
To be honest, you could consider the Fed rate hike to be a kind of damper on the economy. It raises the cost of many items, including those purchased on credit, but it also has repercussions for items that are not purchased on credit. You won't have as much money for other purchases if your monthly mortgage or auto payment takes up a larger portion of your income. In actuality, it impacts everything, including items that aren't purchased with credit. I am concerned about the excessive delay in the Federal Reserve's decision-making process. In essence, the information is a little outdated. I believe the Federal Reserve will be cautious to reduce interest rates, just as they were slow to raise them. That seems to be the situation. Prior to hitting the 2% target, you have stated that you are prepared to lower interest rates. Do you think there will be a decline in the inflation rate? I am somewhat certain in it. Over the previous few years, I believe we have witnessed that. Is our level of confidence in its sustainable decline to 2% high enough? I'm still not ready to say that. You haven't seen anything yet, so if you thought what we've seen from Tesla thus far was amazing, buckle up. We're here to explain everything to you today as we prepare for what promises to be an incredible second phase of Tesla's journey. Future developments could include everything from surprise stock price spikes to groundbreaking discoveries that could completely transform the electric vehicle market. We'll analyze the most recent financial projections, get into the specifics of Tesla's upcoming significant actions, and talk about how these might impact the market and your investment approach in this episode. In the upcoming months, we'll be watching Elon Musk and the Tesla team to see how they handle the chances and obstacles. Are you eager to learn more about what Tesla's second phase will bring? Do you want to know how this might affect transportation in the future? After that, click the like and subscribe buttons, and let's begin. Greetings from Tesla Stock News. Hello, everybody. Let's start with some significant news that might cause a stir for Tesla and everyone watching interest rates. Jerome Powell, the chair of the Federal Reserve, reported to Congress on July 9 and 10. This is significant because his words have the power to significantly affect the markets. Isn't it kind of interesting? In September, he will most likely lower rates. Without a question, Joe Biden wrecked our economy, and Jay Powell is having a hard time figuring out how to turn it around. Listen, the average American's purchasing power has decreased by almost $28,000 over the past 3.5 years. Rate cuts will be beneficial, but the reality is that they appear to be politically motivated when they are implemented in September. One thing I learned from my talk with Jay Powell yesterday is that he believes inflation will decline. Therefore, I believe that the likelihood of rate decreases is increasing. In the end, though, there will be a lot of discussion about the political character of those rate decreases if you do it in September rather than July. Everyone who owns Tesla stock or is considering interest rates should pay attention now. Why? Because the Fed may lower interest rates in September, which will affect not only your savings and loans, but also the performance of businesses like Tesla. Speaking of Tesla, the company is now experiencing a period of slower production. This is more than a minor setback. It indicates that they are unable to provide lower interest rates as they occasionally do. And believe me when I say that this may make things more difficult in the upcoming quarter as they rush to resume production. If you're keeping an eye on Tesla's cash flow, be prepared for some bumps in the road. Additionally, inflation is a constant threat, isn't it? Here too, Tesla is having some difficulties. The average Joe or Jane may not find things more affordable, even if the Fed lowers interest rates to make borrowing less expensive. It's a mixed bag, as the Producer Price Index, or PPI, is predicted to rise somewhat. Although it's all up in the air, some analysts believe that this might possibly provide a slight lift to Tesla's stock. When Tesla announced its most recent earnings on July 23rd, the excitement was palpable. It's turning out to be quite the stock market roller coaster, so this isn't just any earnings report. At the moment, Tesla's stock may appear to be merely surviving, steady but unimpressive. But beneath this serene exterior, a storm is building that might violently awaken this dormant behemoth. We anticipate more than simply changes with the impending earnings announcement. We anticipate pyrotechnics. As the financial community waits anxiously, the anticipation is growing. What is causing this enthusiasm? According to circulating rumors, Tesla may be making a revolutionary move by inviting the former CEO of Uber to join the company. This isn't just any team addition. It's a calculated move that might provide Tesla an even greater competitive advantage in the mobility sector by bringing a plethora of experience in expanding tech-driven transportation solutions. The possibilities have everyone excited. Could this indicate that Tesla's business plan is changing? Are they planning to accelerate their driverless car program or expand into ride-sharing? These inquiries are generating conversations on social media, in forums, and among investors who believe that Tesla's approach may undergo a significant change. The speculation is escalating the excitement and curiosity as the results call draws near. Both Tesla fans and investors are anxiously awaiting official announcements to find out whether these rumors will come to pass and what they might entail for the company's future. If accurate, this might be a turning point that awakens Tesla's stock from its dormancy and ushers in a vibrant new era of expansion and innovation. Furthermore, rumors aren't the only things causing a stir. With speculation about results and a potential robotaxi event, Elon Musk, ever the showman, is boosting the enthusiasm. The atmosphere is electrifying, almost like the quiet before a storm, and many are expecting tremendous things. Some people are baffled by Tesla's high price-to-earnings ratio of 102.24 and its forecast earnings per share of $2.50, questioning whether the company is truly worth this much. The price-to-earnings growth ratio, or PEGI ratio, is one statistic that stands out when discussing Tesla's financial indicators. At the moment, Tesla's PEG ratio is at a remarkable 3.16. For comparison, that is about twice the PEGI ratio that is typical of the majority of industrial firms. This is more than simply a figure. It's a powerful indication from the market. It demonstrates that investors are confident rather than merely optimistic, very convinced that Tesla will not only expand but also soar. Why is this important? The PEG ratio aids investors in determining the value of a stock by taking the company's profits growth rate into account. A high PEG ratio, such as Tesla's, indicates that investors anticipate the firm will grow its earnings greatly in the future, which is why they are ready to pay more for the stock now. We're discussing a predicted growth rate of 125% over the next 4 years, so this isn't your typical growth. Consider that. Tesla is not merely making progress, it is anticipated to more than double its profits, which is a very aggressive course. Tesla's constant innovation and pushing the boundaries in the energy and electric vehicle industries are major contributors to this predicted exponential growth. Tesla is constantly moving and changing, whether it's through new models, market expansion, or improvements in battery technology. The market's optimism is a wager that Tesla will keep driving innovation and redefining its sectors. The worst part is that Tesla may experience an intriguing dynamic as a result of such high market expectations. On the one hand, it establishes a high standard that the business must meet, which may spur ongoing advancements and improvements. However, it can also exert pressure on Tesla to fulfill these ambitious goals in order to restore the trust that investors have placed in the company. In any case, this high PEG ratio is a warning sign for everyone who owns Tesla stock or is considering buying, pointing to both the possible high rewards and the risks associated with having high expectations. Regarding Tesla's stock price, some are speculating that we may witness what they refer to as peak euphoria. What does that signify? The experts have calculated a peak euphoria price of $371 per share using complex calculations involving the PEG ratio and growth rate. That's a lot, but don't get ahead of yourself. Although that pricing may be achievable in the future, it is now regarded as quite unrealistic and more of a long-term goal. However, that does not imply that Tesla's future is not bright. A strong fundamental analysis suggests, too,